Hello, everybody. This is Alan Ellman, the Blue Collar Investor, welcoming you to this BCI podcast number 79, titled Adjusting Target Goals with Exchange Traded Funds, or ETFs. We're going to be using a real-life example with SPDR S&P Homebuilders ETF, which trades on the New York Stock Exchange under the ticker symbol XHB. Let's begin this podcast by defining ETFs and how they relate to our trading strategies. Well, an exchange-traded fund, in essence, is a basket of stocks that trade like a single stock. Many of them do have options associated with them. And within that basket of stocks, some are going up in price, some are going down in price. So therefore, as a whole or in its entirety, these securities tend to be less volatile than individual stocks. Now, there are exceptions. So some ETFs are highly volatile. For example, some of the gold ETFs are extremely volatile. So you can't assume that every single ETF has low implied volatility, but generally speaking, they do have lower IV than individual securities. Now, lower IV does translate into lower option premium. So that's one of the disadvantages of using ETFs compared to using individual stocks. Now, one of the advantages is that when we own an ETF, we own a basket of stocks, and therefore, generally speaking, there's better diversification. So because of the lower implied volatility of these securities, it would make sense then to lower what our initial time value return goal range is. Now, when I do individual stocks in normal market conditions, my goal is 2 to 4% a month. I'll go as high as 6% in a strong bull market, but never higher than that. Now, when I'm using ETFs, which I use more in my mom's portfolio, I tend to go in the 1 to 2% range. And I'm talking about the near the money strikes with 1 month contract expirations. So you're going to adjust the initial time value return goal range because of the lower implied volatility of the security. Now, on October 17th, 2019, if we looked at a chart of XHB, we would see, and those of you watching this podcast will see starting top to bottom, that the moving averages were uptrending. And the shorter term 20-day exponential moving average was, in fact, above the longer term 100-day EMA. And the price bars were at or above the 20-day exponential moving average. So that was a bullish signal. Now, if we looked at the MACD histogram, which is a trend and momentum identifying indicator, we would see that that too was uptrending and above zero on the right side of the chart. Another bullish signal. And finally, if we looked at the stochastic oscillator, which is also a momentum identifying parameter, we would see that that also was uptrending. And all those occurred on average to high volume. So we have a bullish chart here, period. We have a bullish price chart. But we're going to look at it from the perspective of defensive and more aggressive positions when we sell the option. Now, if we looked at the 1 month option chain for the November 2019 expirations, we would see that the 44 in the money call generated a bid price of $1.67. The 45 slightly in the money call had a bid price of 98 cents, and the 46 slightly out of the money call had a bid price of 49 cents. So that's the information we glean from an option chain. And then we feed it into the multiple tab of the Ellman calculator, keeping in mind that XHB was trading at 45.18. So the 44 in the money strike generated a time value return on the option. Now that's deducting the intrinsic value component, which the calculator does for us, is 1.1%. That's a 1.1% 1 month return. Now, there's no upside potential because the strike is in the money or lower than current market value. But the downside protection of that 1.1%, that's not break even, is 2.6%. That means that we are guaranteed a 1.1% 1 month return as long as share value does not decline by more than 2.6% by expiration. Now, the slightly in the money 45 strike, kind of call it near the money or almost at the money, generated a return on the option of 1.8%. So at the money or near the money options always give you the highest initial return. Now, once again, it's slightly in the money, so there's no upside potential, and there's a very, very small downside protection of that 1.8% of 0.4%. Now, finally, if we look at a more aggressive or more bullish approach to the covered call writing, we would look at the out of the money 46 strike, which generated also 1.1% of time value, as did the in the money 44 strike. But in this case, we do have upside potential. If the price of the security moved from 45.18 up to the 46 strike, lo and behold, that's an opportunity for an additional 1.8%. So this bullish trade gives us the possibility of a 2.9% 1 month return. Now, there's no downside protection of that 1.1% when we use an out of the money strike, but it will give us a lower break even, of course, which is the price of the stock minus the entire premium. So let's summarize now our approach to ETFs. They do provide more diversification than individual stocks simply because they represent baskets of stocks. But they do generally have a lower implied volatility. Therefore, the premiums are lower than those we generate from individual securities. So we have to manage our expectations, and we have to set lower goals when we're structuring our trade. And all of that makes sense. So before you enter a covered call writing or a put selling trade, you have to establish what your goal is. And if you're using ETFs, then generally speaking, your goals are going to be lower than if you were using individual stocks. So let me remind everybody, as I always do on these podcasts, that our website, www.thebluecollarinvestor.com, has a lot of free resources that will allow us to master these strategies. In particular, look for the free resources link on the black bar at the top of our web pages and our Beginner's Corner tutorial, which is for free for both covered call writing and put selling. And visit our store, which has our best-selling books on option selling. We have calculators, spreadsheets, trade planner, online mentoring programs, as well as our books in ebook format, as well as softcover, and a few are also in hardcover format. Folks, thank you very, very much for taking the time to listen to and or watch this BCI podcast, number 79, Adjusting Target Goals with ETFs. Hope you enjoyed it, and most importantly, I hope you benefit from it. As always, this is Ellman, the Blue Collar Investor. Take care, everybody.